Welcome to this workshop's Social Security Overview, the basics of our national retirement system. I'm Janelle Cross. If you've attended other sessions, you've been introduced to the 3 stages of financial wellness. If this is not familiar, plan to join an Intro to MoneyNav session offered at the beginning of each month, or look for the Money Milestones course, which explores the stages in detail. One of my favorite quotes is, "Being rich is having money, but being wealthy is having time." Financial freedom is the stage where you enjoy the rewards of the discipline and good decisions you've made along the way. It's the place where you no longer are dependent on your paycheck. Well, in other words, retirement. But even if you stop working, you still need to generate a paycheck, and one source of your retirement paycheck is Social Security income. Meet Ida Mae Fuller. This lovely lady was the first to receive a Social Security check in 1940 at age 65. Her check was for $22.54. In 1940, when the Social Security system began, life expectancy for men was 61 and for women was 65. Before receiving her first check, Ida Mae paid a total of $24.75 in Social Security taxes. She lived to age 100 and collected nearly $23,000 in benefits over her lifetime. I guess the system was doomed from the start, and Ida Mae is the one to blame. Social Security reform is at the center of many political debates, and many people speculate about when the system will be bankrupt. While nothing is guaranteed, in fact, you may have seen the disclaimer on your Social Security statement that warns of the shortfall in the system, it is our belief that Social Security will continue to be an important source of retirement income for the foreseeable future. With that in mind, here are some benefits of our nation's retirement system. You cannot outlive your income. If you're alive, you'll get a check. It's adjusted for inflation, which means your paycheck increases, even if only by a little, throughout your retirement. And it's guaranteed. That guarantee is backed by our nation's tax system, which is the funding source for the program. But will Social Security alone be enough to fund your rewarding retirement? Odds are the answer is no. And while it varies for everyone, most folks find that Social Security provides about 30 to 50% of their monthly income. Your benefits are based on the wages you've earned. It's a good practice to check the wage history on your Social Security statement. You need to work for at least 10 years to be eligible. Well, technically, you need 40 credits of work history. You earn 1 credit for each calendar quarter worked, so those 10 years don't have to be consecutive. Your benefit is determined by your highest 35 years of earnings. If you haven't worked for 35 years, you'll have a 0 in some of those years. For this reason, it can be helpful to work part-time in your first few years of retirement. A quick note on statements. Many of us no longer receive statements in the mail, so you'll want to visit ssa.gov and establish a login as soon as possible. When it comes time to apply for benefits, you can save yourself a trip to the local Social Security office if you've already applied online. You can apply for benefits as early as age 62. We each have a different full retirement age based on our date of birth. Recent Social Security reform has increased the full retirement age, and this is a trend we expect to see continue. While delayed satisfaction doesn't come naturally to most of us, there is good reason to delay your application for benefits, namely more money. In fact, from age 62 to age 70, you receive an 8% pay raise for each year you wait to begin collecting. Given that nearly 70% of recipients are receiving reduced benefits and that almost 1.8 million of those recipients are over age 90, seems to me the significance of this 8% pay raise is a bit underappreciated. In fact, those 8% pay raises mean that the difference between your paycheck at age 62 versus age 70 is over 75%. If you take just one thing away from this presentation, I hope it's an understanding of what you give up when you take benefits early. Here's a dollars and cents illustration. Assume this is the Social Security benefit schedule by age for Jane. If she applies at age 62, her benefit is $1,500 per month. But if she waits until age 70, her benefit is over $2,600, an increase of more than 75%. For most folks, a portion of their Social Security benefits will be subject to tax. There are two tax situations to be aware of. First, income tax on benefits. No matter when you apply and whether or not you continue to work, part of your check may be subject to income tax depending on your total household tax situation. In fact, about 80% of recipients will pay tax on their benefits. The good news is, regardless of your tax situation, you'll never pay tax on more than 85% of your Social Security check. In fact, most folks pay tax on only half of their benefit amount. The income tax levels used to determine how much of your check is subject to tax change annually, so consult a tax advisor for specific information on your situation. The second tax situation is the impact of working in retirement, or more accurately, after you've started benefits. Important note here, this situation applies to benefits received before full retirement age, which is another reason to consider waiting to collect. If you begin benefits at full retirement age and earn over the annual limit set by the IRS, you will experience a withholding of your benefits. The withholding is $1 for every $2 earned above the annual limit. In the year you reach full retirement age, the limit increases, and the withholding is $1 for every $3 earned over the limit. But if you wait until full retirement age to apply, you can earn as much as you want without any withholding. One note before we leave this topic, this is not a tax, it's a withholding. Any amount withheld will be considered in recalculating your benefit when you do reach full retirement age, which might result in a little bit of a pay raise. Let's discuss when you can apply in different situations. We'll start with individual taxpayers. Benefits are available if you've collected those 40 credits or 10 years of work history. Your check is based on your highest 35 years of earnings. We refer to this as your worker's benefit. You can apply as early as age 62 or as late as age 70. Your full retirement age is based on your date of birth. If you are married at least 1 year, you are eligible to receive 50% of your spouse's worker's benefit. We call this a spousal benefit. To collect, the worker must first apply for their benefit. If the spouse applies at age 62, they receive a reduced benefit. If they wait until full retirement age, they receive 50% of the working spouse's benefit amount. Note, there is no advantage to waiting beyond full retirement age to apply. That 8% delayed retirement credit does not apply to spousal benefits. Finally, if you are married and also worked, you're eligible for two benefit amounts, a spousal benefit and a worker benefit. If you apply before your spouse applies, you're only eligible for your worker benefit. If your spouse later retires and your spousal benefit is higher than your worker's benefit, your check will automatically increase to the higher amount. We can easily get into the weeds here, but just remember, you'll receive the highest amount you're eligible for at any given time. If you are divorced at least 2 years before applying and were married at least 10 years, you are eligible for an ex-spousal benefit. This works just like a spousal benefit. You receive half of your ex-spouse's benefit. Few key things to remember. First, you cannot remarry before age 60. Your ex-spouse does not need to apply for benefits before you can collect. Benefits are reduced if you apply before your full retirement age, like any other benefit type. And if you delay beyond full retirement, like spousal benefits, there are no delayed credits. So no need to wait longer than full retirement age to apply for ex-spousal benefits. And it doesn't matter if your ex-spouse has remarried. Most importantly, your ex will not be notified if you apply. I want to emphasize this one because many folks are not aware. I met a woman who was married for 40 years before divorcing. She had not worked prior to the divorce and did not have enough credits to qualify for a worker's benefit. She was working an entry-level job when I met her, and she was 66 years old and had also been diagnosed with Parkinson's disease. When we checked, we discovered her ex-spousal benefits were almost equal to what she was earning in her job. This allowed her to cut back to a part-time and improve her quality of life. So let's break down the important pieces one more time. First, you cannot remarry before age 60. Your ex does not need to start their benefits before you can collect. Benefits are reduced if you apply before your full retirement age. But if you delay beyond full retirement age, there's no extra 8% pay raise, so no need to wait longer to apply. It doesn't matter if your ex has remarried, you're still eligible. And most important, your ex won't get any sort of notification that you've applied for this benefit. Another lesser known benefit is the survivor's benefit or widow's benefit. If you were married at the time of death and had been married for at least 9 months, you are eligible for a widow's benefit. An important distinction here, widow's benefits are available as soon as age 60, albeit at a reduced amount. You're eligible for the full benefit accumulated by your deceased spouse when you reach your own full retirement age. And like other spousal benefits, there's no benefit to delaying beyond full retirement age your application. If you're widowed, remarried, and employed, you could technically be eligible for 3 different benefit amounts. So let's break this down one more time. If you apply between the ages of 60 and 62, you are only eligible for widow's benefits. You can continue to collect the widow's benefit for as long as you desire. And if you are eligible for other benefit types, a spousal or worker's benefit, you can let those increase. But keep in mind, in order to change from a widow's benefit to another benefit type, it's not automatic. You'll need to reach out to Social Security and submit an application for a different benefit amount. As you can see, there's lots of moving parts in our nation's retirement system, which is why it's important to avoid an automatic take it as soon as I can decision. In addition to different benefits like widow's benefits, there used to be special application strategies called file and suspend and restricted applications. It's important to comment on these situations in case you're getting advice from family and friends. File and suspend allowed folks to collect a spousal benefit before the worker started their benefits, but this ended in 2015. Restricted applications allows you to apply for the lesser benefits for which you are eligible while allowing other benefits to continue to increase at 8% per year. This is currently being phased out and is only an option for folks born before January 2nd, 1954 and not yet age 70. If you work for federal or state government, you'll need to know whether the windfall elimination or government pension offset provisions apply to you. These are reductions in Social Security benefits for folks eligible for a pension from a job where they did not pay Social Security taxes. In any of these specialized situations, it's important to consult an advisor or to contact the local Social Security office. We're covering a lot of ground, and as you can see, this is a very complex topic. But I want to spend our last few minutes emphasizing how important it is to analyze claiming strategies in order to make the most of this valuable benefit. Let's consider John and Jane. John is 6 years older than Jane. He has a full retirement age benefit of $2,291 and a life expectancy of 79 years. Jane has a full retirement age benefit of $2,024 and a life expectancy of 82 years. To keep it simple, let's say both John and Jane worked. And even though they would both be eligible for a spousal benefit in addition to their worker's benefit, we'll consider only the worker's benefit in this illustration. If John and Jane both apply for benefits at age 62, you can see that their checks are reduced from their full retirement amounts. If they live to ages 79 and 82 respectively, they will collect $533,000 in benefits. You can see this is a significant income over the course of the couple's lifetime. Now let's say John and Jane meet with an advisor to analyze their options. The advisor suggests only Jane applies for her benefit now. This allows them to get some money right away, but John waits to collect until he's age 70. At age 70, you can see that John's benefit is significantly higher than his age 62 check. Over the course of their lifetime, they'll collect $597,000, which is $64,000 more than in the take it as soon as you can get it scenario. Note this assumes that John and Jane live to ages 79 and 82 respectively. If they live longer, the difference between this delayed strategy and the apply as soon as you can one is even larger. But how long are you going to live? Well, that's the million-dollar question. Instead of trying to predict life expectancy, you might think about the needs of the last survivor. Since Jane is 6 years younger than John, and women commonly live longer than men, let's assume John predeceases Jane. When a member of a couple passes away, the smaller of the two Social Security checks stops. In the apply as soon as you can scenario, Jane is left with a benefit of $1,612 for life. Had John waited to apply until age 70, however, Jane's widow's benefit would be $3,433 per month, a significant difference. But are there situations where applying early is a good idea? Well, there are. There's several, including a person who has health problems that might impact life expectancy, or a family history of shorter life expectancy. Note when analyzing your benefits, most advisors will be able to determine a break-even age when one scenario is more beneficial than another. Finally, in cases when folks lose their jobs close to retirement age, applying for benefits early might be necessary. But delayed benefits are likely more valuable for healthy folks with a family history of significant longevity, those with a younger spouse, those who plan to continue working, folks who don't have long-term care insurance. In this case, long-term care expenses might require utilization of most of your investment assets, so delaying benefits might be important for a surviving spouse. Also, waiting for the maximum check is important for folks who have not saved and invested as much as they need for retirement. And finally, don't forget about the importance of widow's benefits, which can allow you to build up your worker's benefit. Well, you made it to the finish line. So as we wrap up, let's remember to log on to ssa.gov and check your estimated benefits. Remember, this is not an automatic decision, and you should talk with an advisor before you apply. If a special situation applies to you, contact your Social Security office to learn more. If you plan to work in retirement, make sure you think twice before applying for early benefits, and make sure you understand how your benefits might be taxed. Finally, if you are a widow or know someone who is, make sure they talk to an advisor. With that, I'll remind you that a great next step in your financial wellness journey is to complete your MoneyNav assessment. The questionnaire takes about 5 minutes and results in a series of to-dos or best next steps that are built right into your personalized My MoneyNav dashboard. You can email your financial coach at moneynav.com to receive a link to the assessment. And of course, we hope you'll continue to join us here for Money Mondays. Visit moneynav.com/moneymondays for upcoming sessions and to sign up.